During the sale of investment real estate, it's very important to do a lot of homework and plan for the closing ahead of time while advising your CPA and your real estate attorney. A lot of mistakes happen that can be avoided through doing the proper work ahead of time. One of the good things you should do is have a sample closing statement put together and reviewed both with the real estate attorney and your CPA. As an example, sometimes when selling real estate after an inspection, the buyer might want some credits due to the fact, there's a faulty heater, there's something wrong with the roof. When negotiating these particular issues, it might be much better to simply reduce the overall sale price of the property versus having line items on your closing statement that then can be interpreted as equity received but not put towards the replacement property, effectively meaning that you took constructive receipt of those monies even though you never received them, and now they're taxable boot. So it's very important to go through the closing statement and look for these possible errors, not errors, but there's always a different way to present things. And if you do it properly, you can avoid some costly mistakes by waiting to the very last moment or going to closing and then showing your closing statement to your CPA. There are ways to negotiate the final closing, put certain line items, construct them either as a line item, as a closing cost, if they're a deductible cost. The strategy here is to avoid any taxable boot during your closing and rework the closing statement and make sure that any deductions that are happening are a cost of the closing and deductible. So when you go to purchase your replacement property, you not have been deemed to have already received those concessions as taxable boot. So if you like this video, hit like and subscribe and check out our other videos.